Ladies and gentlemen, boys and girls, children 18 plus. You are tuned in to the Loan Officer Podcast with me, Dustin Owen, and my main man,
JC.
John Coleman.
Dio, what's poppin'?
Hey, your eyes into the camera.
Yeah, it's a thing.
No, you seemed a little bit facetious
It
about
was, yeah, because it was, keep people on their toes.
You don't like having the camera pointed at you, do you?
I'm used to it. I couldn't care less. It's couldn't care less, by the way.
Okay, you couldn't care less.
Yeah.
You are used to having a camera pointed at you.
Yeah, I mean, I've been on stages and stuff. I've been on production. Yeah, it doesn't bother me at all.
Well, I thought it bothered you, like man, I can't be bothered. Get that thing away from me.
Kind of like that, but I play it up.
Yeah, play it up. You're a good-looking dude.
Oh,
People wanna
thank
see
you. Except for the fucking landing strip.
Oh, you're dropping the F-bombs today,
Nah,
John.
I whispered it. I'll bleep it out.
Will you bleep it out?
Mm-hmm. Just for you.
All right, so today's episode, we're going to jump right into it.
Oh, my goodness.
Well, here's the thing. I'm flying out to Wyoming on Saturday. Yes, how nice, right? How nice. Cody, Wyoming, 7D
Happy for
Ranch,
you, man.
my happy place.
I know.
Shout out to my friends at the 7D Ranch in Sunlight Basin. If you ever want to take your family on one of the most epic, week-long retreat-style adventures, and you got the coin.
Yeah, make sure 6 months reserve, 401k, maxing out your IRAs, all that stuff.
Yeah. You're dominating the personal finance side. You're focused on earning, and you're doing a good job. Mm-hmm. You should check out spending some of your hard-earned cash at 7D Ranch.
Yeah, I'm excited to see. Are you going to do the same adventures and same hikes that you did last time, or is it new adventures?
Well, it's a lot of the same, but it's always new.
Right.
It's always new. Mm-hmm. You never know when you're out on trail, like what you're going to see, what you're going to encounter. Yeah.
But you're hella fit now, so when you go on that mountain climb, it shouldn't be a problem for you.
Yes. Well, I'm going to climb a mountain probably. And hopefully I don't die.
Yeah, right.
Or get injured, knock on wood.
That's fine.
But yeah, it's going to be horseback riding, hiking, fly fishing.
No Wi-Fi, no signal.
Hopefully no Wi-Fi, hopefully no signal. I heard a rumor that they were trying to get the Elon Musk, what's that called, Starlink or whatever?
I don't know, man.
Yeah, but nonetheless, I'm pretty amped up about it. So yes, we're trying to get into this episode because then we're going to do another episode. Both these episodes are going to drop next week when I'm actually out of town.
Good for you, man.
You and I actually, though, prepped the audience for this. If you tuned back, not the Jeff Velez episode about home warranties, the one before it. Right. You and I were talking about, hey, I want to do an episode on the mortgage business. Mm-hmm. It's a business. That's what I want to do today.
Nice.
I want to talk about the business behind it because I think if people can understand that it's a business, and this is, by the way, people as consumers, people who are applying for home loans, people are real estate agents and home builders who rely on lenders to fund the transactions for buyers to buy those said properties, as well as folks in the mortgage industry. If people can understand there's a business behind it, it'll help them become better loan officers. It'll help them become more informed consumers. It'll help them become better educated realtors. Right. So across the board, I want to do my best to explain the mortgage business the way that I know it.
Okay.
Before I do it, we do have some business at hand that we have to talk about. Do you want to run with it? Or do you want me to run with it?
You're on fire today. I am not, and I'm not going to stand in your way.
All right. Well, you're a universe person, John.
Very much so.
Okay. This is the first time you're going to hear this out of my mouth. It won't be the last.
I know.
You know what we need, John?
What is that, Dustin?
A publicist.
Okay.
We need a public relations company. We need a booking agent. We need someone out there in the universe who likes what we're doing as much as our fans like what we're doing, that they want to help us introduce this concept, this platform, this material to more people.
To the masses, the super masses.
To the super masses.
Yeah.
Yeah, at some point, who wants to discover TLOP first?
Right? Who wants to be, who
wants to be a part of this journey?
Yeah, right? I feel you.
Okay, I'm going to put it out there.
Okay.
But I think it starts with you and I putting ourselves out there. So we're going to put ourselves out there because we're going to be in Las Vegas, September 20th, September 21st at the Palms Hotel Resort Casino at Mastermind 2022. If you want information regarding this awesome mortgage event, it's on our website. Our website is tloponline.com. That is TLOP online.com. Shout out Jungo. Jungo's agreed to sponsor the lunch. That way, not only can you participate in a town hall format with me and John, but you can also eat lunch. Lunch is courtesy of the people over at Jungo.
Food is going to be bomb, I heard.
Better be bomb.
I hope so.
Yeah, it better be bomb. For what Jungo's going to spend on that food?
There's not be no cafeteria food with the styrofoam.
And people are always like, hey, what's a town hall meeting? A town hall meeting is literally, if you see it during like the political season, it's when someone stands up with a microphone in an audience and they take questions from the audience.
Yeah.
Like, that's my favorite format. It's a ask us anything, no holds bar. It's a way for the audience to get what they came from.
Right.
So many times you go to an event and you get to hear what the speaker wanted you to hear, what that presenter wanted you to hear. Sometimes you go to an event based on the title and the description, and that's not what the presenter gives.
Not at all.
So I like it. Like, look, free form, not afraid of it. It doesn't scare me. Let's get on stage, you and I, and let's let people ask us anything.
Nice.
And we will do our best to answer it based on the world as we know it, or point you in the right direction towards the resources to obtain the answer that you need.
I'm looking forward to it.
Are you? You sound excited.
I am.
You're probably most excited about the steak dinners,
just the
rolling dice.
Just rolling dice. Because now I know the strategy, bro. You go 5, you go 6 and 8 because they get rolled the most. Then you throw in a lucky number. Always play the pass line and just sit there. And every once in a while you might get frisky and go horn high-o.
There you go, John.
I knew nothing about that before until just 30 minutes with D at the crap table, and it's like, oh, I learned everything.
Didn't you do like a bachelor party over in the Bahamas?
I did, but that was after I got all my tips from you.
I hope you didn't take gambling tips from me.
I mean,
I can teach people how to have fun.
Yeah.
I cannot teach you how to win.
No, you win sometimes. You lose some, but you win some.
There you go.
Times.
That's life.
Right.
That's life.
All right, that's business, and let's talk about it as an industry.
Let's talk about the mortgage business.
Okay.
Because there's a lot of business decisions that are being made, especially in years like 2022.
You mean there's more behind it than just rates?
Yes, there is more behind it. So I'm going to start in the very basic.
Okay.
At the very basic, what do people in the mortgage industry do? Well, we create widgets based on what the buyer is willing to purchase. The widgets we make are called home loans or mortgages. Those mortgages end up being packaged together, and they're created into a bond so investors can invest in that bond. That is how our world works. So it's paramount for anyone to first understand we are only going to make a widget if there's a buyer for said widget. It doesn't matter if our widget is gold-plated, if our widget is loaded with the best technology. If no one's willing to buy a gold-plated, best-in-class technology widget, then we're not going to make them. And I use widgets, and I use assembly lines, and I use a purchasing market because it's the easiest way for me to conceptualize what the mortgage industry is. So when a consumer says, I just don't know why you wouldn't give me a loan because my credit score is an 800 and because I have $100,000 in the bank and I'm putting 20% down. And they're correct. Those are great qualities. But I just started my own business. I have to turn around and tell them, well, I'm sorry, the purchasers of widgets don't want the widget that I can make with your criteria, meaning they want you to have a job. Right? So like that's the easiest way to understand those decisions. When loan officers go to their branch manager and they're like, I don't know why our company won't do X, Y, or Z decision. They need to understand that, look, it's not that your employer doesn't want to do that loan. It's just that they have made a business decision that either executing that particular loan is too risky and they take a bigger chance that they're going to lose money, or a bigger chance that if they actually facilitate that transaction, they're going to end up with a loan that they can't sell, that they choose to make a business decision not to provide it, not to put the product offering out there.
Could a mortgage company in theory make any type of, let's say, widget? A widget is like a different type of loan product. Let's say FHA,
Yes.
VA,
Yep.
2-1 buy.
They're all widgets.
Could a mortgage company in theory like make up their own widget and like just say, we're just going to make up this own loan product? Do they need any type of approval from like a governing body, or could Waterstone go out and be like, we're just going to make a Waterstone special plan, and maybe there's only 2 or 3 people that qualify for it, but could you do that in theory if you wanted to?
Great question. So, in the words of Danielle Anderson, it depends. Yes, but no. At the end of the day, we are only going to make things, we meaning the industry, that we can sell. We are only going to make things that have a market out there. So if I'm going to do a loan that I go out and I create, and usually we'd call that a non-QM, non-qualified mortgage, and I can set the underwriting standards, then yes, I can do that. But what happens when I need to raise money? What happens when I have a great opportunity to go acquire, let's say, another company in order to expand my footprint, but I am cash poor, but I'm asset rich? The asset I may have are a bunch of loans that my loan officers went out and originated, but now I can't sell them to raise the cash I need to go acquire that other company to grow my footprint because there's no secondary market. Like, that's the business side behind it. Now, if I'm a bank, then banks have what are called deposits, right? People like you and I need to store our money somewhere. We store it at a bank. Sometimes certain banks have so many deposits, they have to lend money. They're like, look, we're sitting on all of this money. Money, just like with you and I, money sitting in a savings account doesn't do crap for me. Right? What does it earn me? 0.1% interest?
If that.
Yeah, like that's why I don't want to keep a whole lot of cash on hand. Maybe 3 to 6 months of my lifestyle. But other than that, the rest of my money I want to have deployed into other investment vehicles. Banks, that's how they operate. So when a bank is sitting on too much cash, they need to go lend it. So maybe if I was a bank, I'd be willing to take a small portion of that cash and lend it out to that specific product.
Gotcha.
The problem becomes, if I get into a pinch and I need to sell that off, do I have a buyer? That is the business side of the mortgage industry. We as a lender are only going to create a product where there is a buyer, where there is a market. And normally, I'm only going to create a product where there's multiple buyers. Because if I was a seller and there's only one buyer, that buyer has all the control, right? They can dictate to me the price, especially if I'm the person who's in need. So if I'm creating, again, quote unquote, widgets, I want to create widgets that have multiple buyers. I want to create loans and deliver loans into the market. We call that the secondary market, where there are multiple takeouts, because that is my security that I'm going to be able to get fair value or top dollar for whatever product it was that I created. And then you start throwing on compliance and regulation. That also goes into the various business decisions that have to be made. So you, in your questioning, also reminded me, like, let's talk about, well, how do most mortgage lenders operate? We just talked about how banks operate, right? Banks, for the most part, they raise their capital by offering banking services to the average consumer, where we open up checking and savings accounts and CDs. And we give them our cash. In return, they hold it for safekeeping. They allow us to access it basically at will anymore with ATM machines and online banking platforms. But they don't just hold it. They then use it and they lend your money out to Kevin. And then they charge Kevin 5% interest while they're only paying you 0.1% interest, and they're picking up the delta. They're picking up the spread. That is how they raise their liquidity. But if you're a non-bank mortgage company, which the bulk of the mortgage companies out there are non-bank in today's day and age, they have to raise their money the old-fashioned way, which is go borrow it. So they go to, let's say, a large banking institution. It could be Flagstar Bank, it could UBS, it could be Fidelity, and they obtain what's called a warehouse line of credit. Like if you and I want to go open up our own mortgage company.
We could do that?
We could do that.
Okay.
Sure. Yeah, how much net worth do you have first, John?
Chill, bro. Not a lot.
Okay. And more than likely, if you want to go ask a bank like a UBS or a Flagstar or a North Point, shout out to Ashley at North Point, because this is what she does, my girl Ashley Lockaby.
Okay.
She does warehouse lending for North Point Bank. We'd have to go there and we'd have to apply. They'd want to look at our books. They'd want to look at our personal assets, our personal credit, at which point, if we have experience and in the mortgage industry and we can show them some kind of a track history and sign away our lives, true story, they would maybe give us a warehouse line of credit. We could use that warehouse line of credit to fund loans before we sold them. This is the business side. This is how the mortgage industry works. Whether it's a big bank, whether it's a tiny hometown lender, we all are somehow raising capital If you're a bank, you're raising it through deposits. If you're a non-bank, you're raising it by getting a warehouse line of credit. And that's if you qualify. And then we're going to fund our loans on that warehouse line of credit. And then we're going to hope within 5 days or 3 weeks, we're able to sell that loan to the secondary market. Whether we're selling that loan directly to Fannie and Freddie through the cash window, whether we're selling that loan directly to PennyMac or AmeriHome or New Res, you name that aggregator, Wells Fargo, Chase, etc. When we sell that loan, we're able to then pay off the money we borrowed on our warehouse line of credit and pick up our profit. But here's something to keep in mind. This is the business side of the mortgage business. That warehouse lender gets a say in how we operate, John. It's not willy-nilly. Oh, hey, here's a $5 million or $10 million or $100 million or $500 million line of credit.
Go have fun.
Go have fun. It's like, nah. I need to know, John, what type of loans are you funding on our line of credit?
So are the people that with the warehouse lines, are they really the ones that control the strings? They have like the power, so to speak, because they can dictate.
Yeah, I mean, I think everyone has a say.
Okay.
Right? State auditors have a say. The people that I deliver loans to in the secondary market, they have a say. Everybody wants to come audit my mortgage company, right? States, federal agencies, the people I sell loans to, the people I borrow money from, like they all want to audit my financials. Right. They want to see how I operate. They also want to see what type of contingency plan I have in case of a data breach. How do I train my people? How do I continuously educate them in terms of like continuing education? Yeah. What are our procedures for if something goes wrong? How are we going to fix it? Like, what are our emergency backup plans? Like these are all things that when I'm running a mortgage business that transpire. So when I'm talking to a consumer as a loan officer, and I'm a loan officer and my company demands X, Y, and Z out of me, please know your company is not trying to be dicks. Your company is just highly regulated, not just by federal and state, but also by the people they borrow money from, their warehouse lenders, as well as people that they sell loans to, the purchasers of their widgets. And they need to run a business that is sound. They need to run a business that is also going to have longevity, right? Because if you start taking way too many risks, eventually you're going to get caught. You're going to get trapped. And getting caught once could absolutely erase 20, 25 years of success. Okay, this is why it's like paramount for people to understand the decisions that mortgage companies are making, especially today. They're making business decisions. They're not trying to be mean. They're not trying to prevent their loan officers from making a living. They're not trying to prevent the consumer from being able to pay a home loan. What they're trying to do is stay in business. So when I was describing to people that, hey, look, it's paramount for you to understand that your warehouse lender is going to have a say when you're a loan officer and you want to know, well, how come my company doesn't offer this product?
Yeah.
Maybe their warehouse lender doesn't allow them to. So they don't have a way of funding the product. So then it becomes, well, maybe I could then broker the loan. Yes, that is a strategy. When you work for a company that is a direct lender, they're used to funding their own loans, but there's a certain set of products that they don't fund themselves, that they broker out. It's because there's too much risk. Maybe their warehouse lender won't let them fund it. Maybe there's not enough takeouts. There's not enough buyers in the secondary market who want to purchase said product. Therefore, they're like, look, we're fine letting you originate it, but we're not going to fund it ourselves. We're not going to underwrite it ourselves. We're going to make a third party. That way we know that third party is guaranteed to purchase that loan. Because the last thing we need to do is have a loan that we fund on our warehouse line not get purchased. Because by the way, you probably don't know this, but I do know this, and I'll share it with the audience as well as you, John.
Okay.
When a warehouse lender helps me fund a loan, they don't fund 100%.
Oh, they don't?
No. So if I lent you $300,000 and I needed to wire $300,000 to closing, I probably only got 95% of $300,000 from my warehouse lender.
Who ponies up the rest of the money? Me,
homie.
Oh, snap.
Yeah, if I run this company, it's me that has to pony that money. So you times that by 20, 30 closings a day, 100 closings a day. And even if it was only $15,000, well, 15,000 times 10 closings is $150,000.
Yeah.
Right. So now you're starting to times that by by 50 closings,
It's a lot of money.
it's $750,000. So I have to have that cash and that capital. And then when I'm unable to sell the loan, what do? Now I got to put that loan on my books. The problem is I'm paying interest on that warehouse line. And my warehouse line is only yay big. If it's 50 million, it's 50 million. If I have a bunch of loans caught on that warehouse line that I'm unable to sell into the secondary market, there's no purchaser for it. Not only am I paying interest on it, but now there's a cost associated because now that's that many millions of dollars I can't use for future loans.
If you can't sell it, how long does it sit in the secondary market? Forever? Just floats out there? Can you just take the L and pay for it with the interest, or is it like, what if nobody ever?
Well, there's always what they call the scratch and dent market.
Okay.
So if I wanted to take the L, yeah, I could find someone to go give me $250,000 for the $300,000 loan, and I'm just going to write off $50,000.
Oh, gotcha.
Yeah, or normally what I would do is I would service it for a certain period of time. Once you get a decent on-time payment history, 12, 18 months, at that point the loan is seasoned. At that point I can either find a purchaser for it, or maybe I funded the loan, but by the time I funded it, I went to deliver it, the market dried up. And when the market dried up, now I didn't have a purchaser. So I'm going to give you some examples of the market drying up. April 2020, that was when COVID hit. All of a sudden, there was not a market to deliver non-QM loans to, right? There were companies out there, I won't name their names, that all of a sudden, lenders were used to delivering millions of dollars a month to them. All of a sudden, they put their hands up. They said, stop, we're no longer purchasing. COVID has us freaked out. We don't know what this is going to do to our economy. We don't know how many people are going to go into foreclosure. We don't know if the federal government's going to step in and do like a moratorium on foreclosures or forbearance. We're not purchasing it. Yeah, but I got like $5 million of loans, homie. I need to deliver. Like, yeah, sorry about your luck. We're not buying. Okay, well, so that happens. You have what just transpired a couple weeks ago when Sprout went out of business, when FGMC filed bankruptcy. There were lenders that had sent a loan to FGMC, a $2 million loan. FGMC underwrote it. Now, that business decision was meant that that lender had a non-delegated relationship, meaning their relationship wasn't that they had one of their underwriters underwrite the file. They sent it to FGMC. FGMC underwrote it, but that lender still wanted to fund the loan. They didn't want to broker it. They wanted to have to have a correspondent relationship, and they wanted to, because there's business decisions behind that. Maybe you get better pricing. Maybe you're able to make more money. Maybe you don't have to disclose the SRP on the LE to the consumer. Like, there's many reasons why you'd want to have a correspondent relationship versus a wholesale or brokered relationship. But FGMC underwrote it. The mortgage company funded it. FGMC files bankruptcy. They're not purchasing that loan. You just funded a $2 million. You're like, well, and you probably took it to FGMC because the standard players, the Wellses, the Chases, the Penny Macs, the New Reses, that loan was out of scope for them. That wasn't a loan that they would purchase from you. They weren't going to be a buyer. So your one and only takeout just flaked on you. They just dropped the ball, right? We saw it happen. Now, luckily with the COVID aspect, it happened temporarily. But then, there was, it's happening now. So on that same note, I just read an article. So Flagstar Bank, Flagstar Mortgage, they're a top 10 bank, top 10 lender in the country. So they do it all, right? They have a retail mortgage loan origination, wholesale, correspondent. They do warehouse lending, et cetera, et cetera. Their warehouse channel has just come out to some of their clients and said, we're not allowing you to fund non-QM loans on our warehouse line. That was their decision. They're making a business decision. Now, if I'm running a mortgage company, I may have to go to my field, to my sales reps and say, hey, look, guys and girls, we are no longer originating bank statement loans in-house, or we are no longer doing DSCR loans in-house, or we are no longer doing I-10 loans in-house. We now have to broker them. And they're like, whoa, what do you mean we have to broker them now? Look, it's a business decision. Like, shit flows downhill. The people that we rely on to operate our business have come down and said, no. just like those same people, and I know I mentioned this on the episode that we did 2 weeks ago, but those warehouse lenders also are going to audit people's financials. They want to make sure that you're profitable. They want to make sure that you're running a sound business that makes money. Like, no mortgage company is pro bono. This is not a non-for-profit, right? Trust me, and I am an LO at heart. There are many LOs who wish their companies ran a non-for-profit based on how they want to price some loans.
Right.
But no, it's not the case. Like, when you look at your rate sheet, your rate sheet is your rate sheet based on A, your compensation as a loan officer, and B, your company's business model. There are many companies out there whose business model, I don't agree with this model, is to lose money.
All right.
Yeah, not a long-term play. Yeah, pretty risky.
Yeah, it seems like it.
Right, so like when a loan officer's like, but why can't we do what X, Y, and Z mortgage company is doing? I'm like, I kind of feel like my mom, like, well, you know.
Yeah, if your friends are dropping off a bridge, would you do it too?
Yes.
Yeah.
It's like, well, I don't know what type of dire straits they're in. I don't know how they care about investing in technology or staying ahead of the curve or what their play is. But I can tell you their business model right now is that they're losing money on originations. Right. And that is not a long-term recommended play. So when you ask me as a branch manager to follow suit, you're basically asking me to go play Russian roulette because all the cool kids are doing it.
Yeah, doesn't make sense.
Like, nah, or jump off the bridge because your buddy did it.
Yeah.
But, you know, I don't know if your buddy's suicidal or not. I know I'm not. I love my life. I want to keep living it.
When did all this business stuff come into? Because I know just by being
from
on
the beginning.
Really, but I like, for example, like in the '90s when it was wild, wild west, you just needed a pulse and fog a mirror to get a loan. Was there still all?
There was still a business behind it.
There was still a business behind it.
Yeah, and that was the early 2000s, not quite the 90s. So like, I'll talk about that. In 2004, 5, and 6, why were we doing liar loans? Why were we doing fog a mirror loans? That meant if you could fog a mirror, like you put a mirror in someone's nose and it fogged up, you knew
qualified.
You qualify. Why? Because there was a market for it, right? Because there was ratings agencies that were rating these instruments, these bonds as A-rated, and then the bonds were being sold off to pension companies and foreign governments. It was dirty. It was shady. There was a lot of fuzzy math going on. But on the street level, which is where mortgage companies operate, we were only creating products that Wall Street was asking us to make. And then Wall Street was in packaging and selling and marketing those products, and they had a buyer for it. And it was obviously not, it's a stain on the industry. It's a stain on Wall Street. We lived through it. We learned from it. We're better because of it. But to answer your question shortly, because there was a buyer. If there wasn't a buyer, we would never do it. We'd have never been there. And that's why I'm so strong in my sentiments about there not being a housing bubble. Well, there's not going to be a housing bubble for multiple reasons. I'm not saying that home prices couldn't go down by 5 or 10%. Okay, cool. Like, home prices just went up 30% in the past 2 years. If they come back down even 10%, that still means they went up 20% over a 3-year period of time. That's still pretty freaking awesome, right? But the reason why is because we don't have the hysteria of creating easy financing. And back then we had more, we had just a feverish amount of supply as well as demand, and just it was bubble-esque. We don't have those same qualities, and we're not lending that way. Lending's not easy. In fact, it's becoming more difficult when we see what's happening to the non-QM market. When we see companies like Sprout and FGMC struggling, like that makes lending less available and more restrictive. So when you ask a question, like if you're a lender, a borrower, a home buyer, a realtor, et cetera, you're like, well, so why is it that everything that we're doing for the most part is a Fannie, Freddie, VA, FHA loan? Why? Because there's a guaranteed buyer on that.
100%.
There's a guaranteed buyer. Yeah, there's a market. That market doesn't come and go. It's always there. Right. That market is always there. So we can make decisions when we're running a business. We have patterns that we can follow. And it makes it very easy to continuously deliver those loans. And then there's certain loans, whether they're private label securities, PLSs, or whether they're non-QMs, where that market ebbs and flows and fluctuates. And that's where those business decisions come and go, right? So like if I'm a loan officer, I may have worked for a bank, and that bank for 4 or 5 years dominated the condo market in a certain market. Maybe it's in Pensacola, Florida, right? Gulf Shores, Alabama. That bank just dominated. We had the best product in-house. We were crushing the competition. And then one day the bank wakes up and said, yep, we're done. We're full.
What? But that's how I make my money.
Yeah, if you're a loan officer, yes. If you're a realtor, used to referring that, but they're like, we're done. Well, why are they done? Well, because they're full. Because when they look at their portfolio of investments, and an investment is that bank doing that loan, right? Because they took John's Coleman savings account, times it by another 1,000 John Colemans, and then they started lending out money on non-warrantable condos in a resort beach community. Once they've lent out what they feel like is enough, then they raise their hand and say, enough's enough, I'm done. They made a business decision. It has nothing to do with being mean to their loan officer, being mean to the borrowers. No, it very well could have been an auditor came in and said, whew, do you see how exposed you are?
You guys are top heavy with this one product. You might want to diversify.
Correct. Hey, maybe you need to go back into commercial lending.
Right.
Maybe you need to start, opening up money to used car sales. You need to diversify. You're running a bank. A bank is a business. So it's understanding that concept, saying, oh, that's why.
Right.
So ready? Let's talk about this. Rates right now are 6.5%. 6.5%, give or take. I don't, when you're listening, just know that this is 2022, okay? Right. But 6.5%, it could be 6, it could be 7. There's so many factors. By the way, there's like 28 factors that go into someone's interest rate. But let's just say they're about 6.5% or 6%, and you can't get what's called par pricing. Par pricing would mean the consumer is not paying any type of discount point for that particular rate. Right now, there's many loans where you can't find par pricing. By the way, there's a business decision behind that. The reason is that the market, Wall Street, the people who are purchasing these loans after they are closed, packaged, converted into a security, they are saying, based on our research, based on our experience, based on hypotheses that we have created using super smart people with super smart computers, we believe the likelihood of this loan paying off early is high. When someone is purchasing a bond, they don't want it to pay off early. They expect it to have a certain lifespan, 7 years, 10 years, 5 years, what have you. So if I go out and purchase something and it doesn't materialize the way that I anticipated it to, and it pays off early, you impacted my investment strategy, because that's the people who are buying these bonds. There's some kind of investors. Again, pensions, life insurance companies, hedge funds, other countries, etc. So I have to factor that in if I'm a purchaser, that the loans that I'm buying today very well will have a 3 times more likelihood to have a rapid prepay. So I'm not going to pay you $100 or par. I'm only going to pay you $99 because I have to factor that into my decision. And if I can buy this security for $99 instead of $100, it makes sense. Well, if I am the widget maker, that means I can't make widgets that have par pricing. Every one of my widgets, I have to charge the consumer that 100 basis points, right? The difference between 100 and 99 is 100 basis points, or 1. And that's why you see the pricing that you see. It's not that your secondary market vice president and his team or her team are a bunch of crackheads.
Right.
It's not because, oh my God, our new CEO is trying to pad his pockets. No, it's because there's a purchaser on the other end, and that purchaser is not comfortable paying you 100 for a security that they feel like has a 3 times more likelihood of prepaying, so they'll only pay you $99.
Is that like the knee-jerk sentiment that loan officers have? Like, oh, my company's trying to jerk me over because they don't want to do this, and there's really all these other factors.
Well, yeah, lack of education can lead people down a path of various assumptions, and some are wackadoodle and crazy and off the wall. Some of them come from being scared, but most of them come from being just not educated, not fully understand. So like the point of today's episode, and I know we're getting long, but I could go on and on and on, like understanding it's a business. And the last thing I want to say about understanding it's a business, this is for my loan officers. This is for my loan officers, especially those LOs, those guys and girls who are out there who are self-generating, who are creating their own brand, their own following, their own database of referral sources, their own database of past clients. I can't stress this enough. You are a business owner. Start acting like it, start thinking like it, start making decisions like a business owner. I know you may work for Fairway, you may work for Guild, you may work for Cardinal, you may work for Waterstone, you may work for Cross Country. High five. That is the umbrella that you operate under. But your mindset is one that you too are a business owner. You need to make business decisions based on what works best for you, both short-term and long-term. And I find too many loan officers never achieved the level of success that they sought out to because they were unable to think like business owners and business operators. They only could think like a salesperson. They are a sales rep, a loan officer. That's not the case. Now, if you work in a different environment where maybe leads are provided to you, maybe it's okay that you currently think mostly like a sales rep, mostly like a loan officer. Now, I'm going to encourage you to go back to one of our very first episodes and listen to Louis Valsaint talk about entrepreneurship, because I'm still going to encourage you to become an entrepreneur if that's where you work. But for everyone else, it's learning. Learn the business. Understand the why behind it. When you two are running your business, run a business. You work for John Coleman LLC. Yes, I know you may be a loan officer at XYZ Mortgage Company, Finance of America, but you work for John Coleman. You need to make business decisions based on John Coleman, but you have to also recognize and understand your company has to make business decisions based on what's best for them. And you need your mortgage company making money. Because if they're not making money, you'll be looking for a new job. If they're not making money, they're not investing in technology. If they're not investing in technology, you're not going to survive 2024 and 2025. You're not going to be around to see it, right? You need to be investing in products, but safe products that has a buyer behind it. You need to, and by the way, when you need to, like there are auditors who mandate this. There are warehouse lenders who mandate this. There are stakeholders, those companies that we deliver loans to. We call them our takeouts, or we'd call them the aggregators. That they too are coming in and they're looking at our business model. How do we operate? How do we train? What is our culture? What type of loans are we originating? What type of people are we helping? You need to make sure that your company is adhering to those so that you are around tomorrow, next month, next quarter, next year, and that you're not just surviving, but hopefully that you're thriving. So understand that and promote that. Like, I don't care what company you work for, you should promote your company making sound decisions, even if it means you didn't get that loan today. Right? I'm going to end on this. There's an awesome clip on YouTube from Jocko Willink, and it's like 6 years old now. If you just Googled Jocko Good, G-O-O-D, I love it. I'm going to find a way to incorporate it in like a sales meeting or our next sales rally, or maybe when we go out to Vegas or the next Vegas type event that we end up doing, and it's good. And it's Jocko who's talking like this because he's a badass at everything in life. But he's like, you didn't get that job promotion? Good. Now you have an opportunity to work harder. Your next event was canceled? Good. That means you have more time to prepare. You lost that loan to rate? Good. Now you can work on your sales presentation skills. Good should be the answer when you find out that your mortgage company doesn't do something you wish they did. Hopefully it's good, because that's the right decision that we need to make sure that we not only survive but thrive in the future. Good. Good, good, good. Do I run a good business? Is it sound? Is it reliable? Is it long-term? These are all things that, regardless of where you are in your career, what you do for a living, I think we all should be wanting to work for a company that makes sound business decisions, but we first have to understand them. We too should be making sound business decisions because we have to understand them.
Well said.
Any other questions as it pertains to the mortgage business?
I actually do.
Because I am going to have to find a way to wrap this up.
Yeah.
But
that was powerful.
Because we could go on and on because there's way more that we haven't even discussed.
Right.
I think what many people fail to recognize, the mortgage business is more than just a home borrower wanting to buy a house who has a realtor involved and a loan officer.
Right.
It's more than just processors and underwriters and closers. Like there is compliance, there is marketing, there is legal, there's servicing, there's warehouse lending. Like
it's crazy.
It's a business, people. It is the mortgage industry. There's about 5 major silos. It employs hundreds of thousands of people. But your question was,
all right, to end on this. Since it's a business, is there ever a threat of it becoming a monopoly, like what we see with telecommunications and cell phone companies all being like, there's like 2 main players, AT&T and Sprint, and that's it?
No.
No.
The number one lender in America has to be Rocket. Rocket Companies, Rocket Mortgage. Pretty sure that their market share is less than 10%, John.
Really?
The mortgage industry is one of the most fractionalized industries that I'm aware of. I'm talking major players, top 10 lenders have single-digit penetration.
Really?
Single-digit
I would have
penetration.
never thought that.
Yes. Yes. It's it'd be a really cool case study for like some Harvard MBA candidate or PhD candidate. Like I'm curious how it would compare to other industries, but no. Nope. The monopoly may be like, hey, us fractionalized lenders can really only deliver loans to Fannie and Freddie, right? But that's actually almost an experiment in socialism a little bit. When you think about, we rely on the U.S. government for our housing industry to operate. That is a crazy conundrum. Like, we can't figure out whether or not we want universal health care, but I'm going to tell you all, whether you like it or not, we have the housing industry that we have because of the U.S. government. If it wasn't for Fannie Mae and Freddie Mac, the FHA, the USDA, and the Department of Veteran Affairs, none of us would have 15-year, 20-year, or 30-year fixed mortgages. That's a whole nother. That's a whole nother show, a whole nother episode.
All right.
And that doesn't even really get into like the business aspect.
All right, cool.
That's just a little bit. Things that make you say, Yeah.
Okay.
Hey, John, if people wanted to like get a hold of us and find us, what's a good way for them to do that?
The best way is to go to the website, tloponline.com. We have all of our social handles on there. But if you want to get a hold of Dustin Owen himself, the best place is LinkedIn. Just go to LinkedIn and type in Dustin Owen. He's all over there. He has, how many, 15,000 people now you're connected with on there?
Something like that, John.
Damn, that's a small university.
Something like that. It is a small university. I like how you said that. Hey, if you're interested in going to a badass mortgage event this year, plus a really cool city, plus hang out with 2 cool dudes, come hang out with us in Las Vegas. Attend Mortgage Mastermind. The website that John mentioned, there's information on the home screen. If you want to get a hold of John, I promise you only one person is commenting and communicating to people who go to the website. So if you do like a contact us,
it goes to me.
It goes to John Coleman.
Yeah, so.
But he's John Coleman. I'm Dustin Owen. I hope you appreciated that episode. You learned a thing or two. If you want to connect with me on LinkedIn, as John said. That is all the time we have for you today, but we will catch you on the next episode. Peace.